This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil prices will be under pressure over the next 2 years as global production growth outpaces demand, the U.S. Energy Information Administration said on Tuesday in its short-term energy outlook report. Many analysts expect an oversupplied oil market this year, after demand growth slowed sharply in 2024 in the biggest energy-consuming countries, the U.S. and China. The EIA said it expects Brent crude oil prices to fall 8% to average $74 a barrel in 2025, then fall further to $66 a barrel in 2026. The EIA slightly raised its estimate for record U.S. oil production this year, to 13.55 million barrels per day, from its prior estimate of 13.52 million barrels of oil per day.
Oil shipping rates extended their rally on expectations of a tightening in global tanker supply from wider U.S. sanctions on Russia's fleet and traders' demand for ships to load Middle East oil for Asia, industry sources said on Wednesday. On Tuesday, Shell booked 3 very large crude carriers, capable of carrying up to 2 million barrels of oil, at the rate of world-scale 70 to load Middle East crude in early February, and Chinese refiner Shenghong Petrochemical booked 2 VLCCs for the same loading period at the same rate, a shipbroker said. Traders are expected to seek more tankers to load crude from Saudi Arabia in February, which could drive freight rates higher, the shipbroker said.
Moving on to the top news in the energy sector.
The latest round of U.S. sanctions against Russian oil could significantly disrupt the country's oil supply chains, the International Energy Agency said in a monthly report on Wednesday, potentially tightening the global market. Even so, the outlook from the IEA, which advises industrialized countries, still suggests the market will be in surplus this year as supply growth led by countries outside the OPEC+ producer group exceeds subdued expansion in world demand. New U.S. sanctions on Iran and Russia cover entities that handled more than a third of Russian and Iranian crude exports in 2024, the IEA said, but it held off from factoring in the measures into its supply forecasts for now.
Chris Wright, President-elect Donald Trump's pick to head the U.S. Energy Department, will tell U.S. senators in his confirmation hearing on Wednesday his first priority is expanding domestic energy production, including liquefied natural gas and nuclear power. Wright, 59, believes fossil fuels are the key to ending world poverty, which is a greater problem than climate change's distant threat, according to a report he wrote as CEO of oilfield services company Liberty Energy. Wright supports some fossil fuel alternatives, such as small nuclear power reactors, which are not yet commercially available, and geothermal power. But he has criticized solar and wind power as insufficient. Next, we have the top news in metal market. The European Commission intends to propose a ban on imports of Russian primary aluminium in its 16th package of sanctions against Russia over its invasion of Ukraine, European Union diplomats said on Tuesday. EU countries hope to pass a 16th package of restrictions in February to mark the third anniversary of the war. The Commission held informal meetings with EU countries on Tuesday to discuss details of the forthcoming package, the sources said. One source added that the ban would be phased in. In a letter late last year, 10 EU countries proposed further sanctions on Russian trade, including its output of metals such as aluminium.
Gold prices firmed on Wednesday as the US dollar and Treasury yields retreated, while market participants awaited US inflation data for clues on the Federal Reserve's interest rate strategy. Spot gold gained 0.4% to $2,687.59 per ounce by 11:07 GMT. U.S. gold futures were up more than 1% at $2,710. The dollar index eased 0.2%, making bullion more attractive for other currency holders. The benchmark 10-year Treasury yields also slipped.
We will now look at the top news in the agricultural sector.
Malaysian palm oil futures closed lower on Wednesday, tracking rival SoyOil's weakness in Dalian and Chicago markets and lack of fresh demand. The benchmark palm oil contract for March delivery on the Bursa Malaysia Derivatives Exchange lost 75 ringgit, or 1.69%, to 4,362 ringgit, $969.98, a metric ton at the close. The futures have been pressured by lack of fresh demand from the market, which will continue in the next 2 to 3 months until March, said Paramalingam Subramaniam, director at Selangor-based brokerage Pelinding Bestari.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.